All right, so picture this. You're sipping your morning coffee, checking your bank account, and bam, a dividend payment hits. Not quarterly, but monthly.
That's right.
We're talking about Realty Income, a REIT that's making waves. They call it the best monthly dividend company, but can it really turn a $100,000 investment into a $1 million portfolio?
That's the question, isn't it?
That's what we're diving into today. We're going to break down a YouTube video from John's Money Adventures that really gets into this whole realty income thing.
Yeah, it's a good one.
Whether you're a seasoned investor or you're just starting to think about passive income, this deep dive has something for you.
Absolutely. And what's really interesting right now is this whole climate of rising inflation and these low interest rates. It's really pushing people to think outside the box, right? Beyond those traditional savings accounts to figure out how to generate some passive income.
It's like your money's just melting away sitting there. So where do REITs fit into all of this?
Yeah, so REITs, or real estate investment trusts, they offer a way to invest in real estate without actually having to go out and buy properties yourself.
Okay.
It's kind of like owning a slice of a giant real estate pie.
Got it.
And Realty Income, they're famous for those monthly dividend payouts, which is a pretty attractive feature.
Yeah, for sure.
And their current yield is sitting at 5.5%, which is significantly higher than what you would get with a traditional savings account or even government bonds.
Okay, 5.5% monthly, that definitely has my attention. But Realty Income isn't the only REIT out there. So what makes them stand out from the crowd? What makes them like the star quarterback of REITs?
Well, size definitely plays a role. I mean, we're talking about a company with a market cap of over $50 billion.
Wow.
Which is massive, but their real edge, their secret sauce is their strategy. They focus on something called single-tenant net lease properties.
Single-tenant net lease properties.
Single-tenant net lease properties. That sounds a little technical.
It is a bit jargony.
Yeah, can you break that down for us?
Sure. Imagine you own a building and you rent it out to, let's say, a Walgreens. They're the single tenant.
And now with a net lease, they're responsible for all the headaches, all the property taxes, insurance, building maintenance. You just collect that rent check every month.
So Realty Income gets to be the landlord without all the hassle of actually, being a landlord.
Exactly. It's low hassle, consistent income. Now to see the difference, let's compare them to another big name, Simon Property Group, or SPG. They're all about malls and high-end retail.
Right, those fancy malls with all the designer stores.
Precisely. But when the economy takes a hit, people tend to cut back on that luxury spending first.
Yeah, makes sense.
Which makes SPG a bit more vulnerable to those economic downturns. Realty Income, on the other hand, they focus on those everyday essential businesses, pharmacies, grocery stores, even those gas stations you see on every corner.
So even if things get tough, people still need their prescriptions, their groceries, their gas.
Exactly. It's a brilliant strategy, really.
So Realty Income's approach almost seems recession-proof.
You could say that they've positioned themselves really well, and that stability is reflected in their business model, too. They sign these long-term net lease agreements with their tenants, often for a decade or even more.
10 years. That's a pretty serious commitment.
Yeah.
What's the advantage of that?
Predictability. It means predictable income for Realty Income, predictable expenses for the tenant. It minimizes risk for both sides. And remember those investment-grade tenants we talked about, like Dollar General, 7-Eleven? These are not risky startups.
These are established companies.
Exactly. It's like they're building a fortress of predictable income, brick by brick, lease by lease. Now let's talk about their financial health. Can they actually back up those dividend payments? Are they all show, or do they have the substance to match?
That's the million-dollar question, right?
Okay.
What does their financial picture actually look like?
Well, at first glance, their valuation metrics might seem a bit high.
Okay.
But think of it like buying a well-maintained used car. You might pay a bit more up front, but you're getting that reliability and peace of mind.
So it's not just about the sticker price. It's about long-term value.
That's right. And Realty Income, they're not messing around with debt. They're very conservative in their approach, making sure they can keep those dividend payments flowing even if the economy gets a little shaky.
No risky bets, no over-leveraging. Just steady, responsible management.
It sounds like they're really focused on taking care of their investors.
Absolutely. And speaking of taking care of investors, let's talk about dividend growth. They've earned that title of Dividend Aristocrat for a reason.
Dividend Aristocrat. Sounds pretty impressive. What does that actually mean?
It means they've consistently increased their dividend payouts for over 26 years straight.
Wow.
Think about that. Through market crashes, recessions, they've kept those dividends not just steady, but growing.
26 years in a row. That's incredible. It's like they're saying, we're in this for the long haul and we're bringing our investors along with us.
Exactly. And their monthly dividend payment schedule is another big plus. It allows investors to reinvest those dividends more quickly and have more flexibility compared to traditional quarterly payouts. So it's like getting a little bonus every single month instead of waiting 3 months for a payout.
Right. Now let's get to the big question. Can Realty Income really turn a $100,000 investment into a $1 million portfolio?
All right, let's dive into those projections. I'm on the edge of my seat.
Okay, so imagine you invest $100,000 today, you reinvest all those dividends, and we'll assume an average annual dividend growth rate of 3.93%. Of course, these are just projections based on past performance.
Right, no crystal ball.
Exactly. But let's see what the numbers tell us.
Fair.
So in year 1, your investment grows to $105,504.13. But by year 10, it's more than doubled, reaching $177,604.13.
We're already seeing the magic of compounding at work.
Right. Now fast forward to year 20, and your investment hits an impressive $277,988. But here's where things get really interesting.
Yeah.
Year 30 rolls around.
Drum roll, please.
Your initial investment has multiplied over 14 times, reaching a staggering $1,453,582. And get this, you're now generating an annual dividend income of $80,115, which breaks down to a monthly income of about $6,676.
Wait, hold on. You're saying that by investing $100,000 today and letting it ride for 30 years, you could potentially be pulling in over $6,000 per month in passive income?
It's a compelling projection, no doubt.
Yeah.
But again, these are just estimates based on historical data. The future can be unpredictable.
Right, there are always risks, and no investment is foolproof. But this definitely paints a promising picture for Realty Income's potential.
It's essential to remember that even the most promising investments have their risks.
Right, of course.
And with Realty Income, one thing to consider is interest rate sensitivity.
Okay, interest rates, they can be a bit of a wild card.
Yeah.
How do they actually impact a company like Realty Income?
Well, when interest rates go up, it becomes more expensive for companies to borrow money.
Makes sense.
This can affect Realty Income's ability to buy new properties or refinance their existing debt,
Right.
potentially impacting their growth and those dividend payouts we're all excited about.
So rising interest rates could put a bit of a squeeze on their finances.
Yeah.
What else should investors keep in mind?
The overall health of the economy is a big factor too.
Yeah.
Even though Realty Income focuses on those essential businesses, a severe economic downturn could still impact consumer spending.
Right, even those essential businesses might see a dip if everyone's cutting back.
Exactly. It's a good reminder that no investment is completely immune to those broader economic forces.
True. So even with those long-term leases, there's still some risk involved.
There's always some level of risk, and that's why diversification is so important in any investment portfolio.
Right, don't put all your eggs in one basket.
Exactly. Spreading your investments across different asset classes and sectors, that's a smart way to manage that risk and potentially boost your overall returns.
Now, before we move on, I want to circle back to something you mentioned earlier about investor confidence and how it's reflected in Realty Income's valuation.
Right.
Can you unpack that a bit more for me?
Sure. The stock market isn't just about numbers on a spreadsheet.
Right, it's more than that.
It's also driven by psychology. You know how investors feel about a company? Investor sentiment plays a huge role in determining a company's valuation.
So emotions and perceptions are part of the equation too.
Exactly. Think about it this way. If you're buying a house, you're not just looking at the square footage and the number of bedrooms.
Right.
You're also thinking about the neighborhood, the curb appeal, those intangible things that contribute to the overall value.
It's like that gut feeling you get about a place.
Exactly. And with Realty Income, their track record speaks for itself: consistent dividend growth, a focus on those essential businesses, a conservative approach to debt.
Yeah.
All of these factors contribute to a perception of reliability and stability.
They've built a reputation for being that steady Eddie in the investment world.
Right, and that reputation translates into investor confidence, which is reflected in their higher valuation. Investors are willing to pay a premium for a company that they believe will deliver consistent returns over time.
It's like buying a well-established brand. You're paying for that peace of mind, that proven track record.
Exactly. But it's important to keep in mind that investor confidence isn't static.
Right, it can change.
It can fluctuate market conditions, economic outlooks. Even a news headline can shift perceptions.
So it's not a set it and forget it kind of thing?
Definitely not.
Yeah.
Investor confidence can ebb and flow, impacting a company's value.
So investors need to stay informed and adapt as things change.
Absolutely. That's why it's so important to stay up to date on market trends and do your research before making any decisions.
Great advice. We've covered a lot of ground today, from Realty Income's unique approach to generating passive income to those important risks investors need to be aware of.
It's been a great discussion, really digging into the details of their business model and exploring those projections for turning $100,000 into $1 million portfolio.
Exactly. And as we wrap up our deep dive into Realty Income, I want to leave our listeners with a thought-provoking question.
Okay, I'm listening.
We've talked about Realty Income's impressive past performance, but let's imagine a world where interest rates stay low for an extended period. How might that affect the attractiveness of REITs like Realty Income? And what other investment opportunities might emerge in that kind of environment?
That's a great question. Really gets us thinking about the big picture. If interest rates were to stay low for a long time, it could actually make REITs like Realty Income even more appealing to investors.
Okay, so low interest rates could make REITs even more attractive. That seems a little counterintuitive. Wouldn't it be the opposite?
Yeah, you might think so, but here's the thing. When interest rates are low, borrowing money becomes cheaper.
Right.
And that makes it easier for REITs to acquire new properties, expand their portfolios, maybe even increase those dividend payouts.
So it's like a boost for REITs. It gives them more financial flexibility.
Exactly. And for investors looking for yield, REITs become even more tempting when those bond yields are looking pretty small.
It makes sense. When those bond yields are low, investors are going to start looking for alternatives.
For sure.
Right.
Now, in terms of other investment opportunities that might emerge in a prolonged low interest rate environment, we could see a surge in growth stocks.
Growth stocks, those are the companies that are expected to grow faster than the average, right? They're kind of like the resources of the market.
Exactly. And low interest rates fuel that growth because companies have access to cheaper capital.
Right.
They can use that money to invest in R&D, expand into new markets, or even acquire other businesses.
It's like a growth spurt for the entire economy.
It can be. But remember, growth stocks tend to be more volatile than value stocks, especially in the short term.
Higher risk, higher reward, I guess.
That's the trade-off. Investors need to really consider their risk tolerance and their investment goals before jumping into growth stocks.
I'm curious, would low interest rates impact physical real estate too? Not just REITs. Like, would it be a good time to buy a house, for example?
Potentially, yes. Lower interest rates make mortgages more affordable, which can increase demand for housing and push up property values.
So a potential win-win for homeowners and real estate investors.
Exactly. But it's important to remember that real estate is very local. Trends can be totally different depending on the location, the local economy, all sorts of things.
So no one-size-fits-all answers?
Nope. Real estate is all about location, location, location. Always do your research. Understand the specifics of the market you're looking at.
Great advice.
Yeah.
And before we wrap up, I think it's important to remember that low interest rates aren't forever.
Right.
They're cyclical, they go up and down, and they will eventually rise again.
Absolutely. And when those rates start climbing, investors need to reassess their strategy and make adjustments to stay aligned with their long-term goals.
It's not a set it and forget it situation. Investing takes ongoing attention and adaptation as the market changes.
Couldn't agree more. Well, I think we've covered a lot of ground today, from the specifics of Realty Income strategy to the broader implications of low interest rates.
It's been a fascinating deep dive exploring those monthly dividends and how interconnected everything is in the financial markets.
And as always, remember, investing is a journey of continuous learning. Stay curious, stay informed, and keep seeking knowledge.
Couldn't have said it better myself.
Yeah.
So to all our listeners out there, keep those questions coming, keep exploring those investment opportunities, and most importantly, keep learning.
Until next time, happy investing.